Nandaji, welcome to you. Please start the program.
Thank you. Thank you, Mr. Chairman. A very good evening, ladies and gentlemen. We are back with yet another exciting program on internal audit. My son Manas Chuk is taking the lead today. He will be speaking. I give my salutations to the chairman of the board, GST man Rainder Kumar, secretary Madam Aarti Bansal, Arunji, and more importantly, all members have come here to go home more enlightened. Ladies and gentlemen, I'm traveling, so I just stepped in to give my best wishes to this program. Over to Mr. Rainder Kumar for further proceedings. Mr. Kumar, the dice is all yours. Best wishes to this webinar. It is going to be a very exciting webinar on internal audit of international regulations by CA Manas Chuk. Thanks a lot. Please go ahead, sir.
Thank you, Nandaji. Esteemed members who have joined for this program today. It is such a pleasant experience for me to see CA Manas Chug, whom I have known as a student of chartered accountancy. A young boy, I must say, a young man. From a boy, he has graduated to a man. And today, he is here with us to make a wonderful presentation on a topic which many of us don't practice. In fact, Manas Chug is the son of the illustrious Central Council member from the northern region, CA Hansraj Bhai Chug. Their road is very different in practice. They do work which generally chartered accountants shy away from: customs, foreign trade policy, such type of things which even I also cannot immediately think about. So when I spoke that day to Manas Chug and said, Manas, you're doing such great job. Why don't you make a presentation for us and enlighten our professional brothers and sisters about what you're doing and what is the way ahead for all of us in this area, niche area. And here he is with before all of you, a qualified chartered accountant with almost about 5 years experience now, working with his father. Today, children don't work with their father and they don't become chartered accountants, seeing their fathers flogging. But here before us, in all smiles, we have wonderful personality of CA Manas Chug, who has taken the right decision to practice and follow the footsteps of his illustrious father. Thank you, Manasji, for being here with us today. And I know all of us are going to take home excellent presentations from you. Thank you, CA Aarti Bansal, for as usual coordinating it and leading from the front on all admin matters of the committee. I'm confident that you will give company to Manas Chug for this whole session and also enlighten us on the various aspects the committee is going to do in the future also. Arun Agarwal and Henil, who are offering technical support. Thank you very much. Over to Aarti for a brief remarks and then to Manas Chug. You're on mute, Aarti. You're on mute.
Thank you, sir, for giving a welcome address. Now I welcome to all the participants. Our today's speaker, CA Manoj Chug, sir, Vice Chairman, sir, CA Charanjot Singh Nanda, sir, and my team members, Arun Agarwal and technical support, Hamid. Now I would like to introduce our today's speaker, CA Manoj Chug, Manas Chug, who is taking a unique topic. I think it's first time covered by our webinars, Understanding International Trade Regulations from Internal Auditor's Lens. Manas Chug, sir, is a chartered accountant and an economic graduate from DU. He is earlier with Deloitte, and now he is leading a consultancy firm and advising clients on economic laws and taxation laws governing international trade and investments, that is FEMA, FTP, and SCZ, Customs Act, GSTs, FTAs, anti-dumping, and other related economics laws. He has served various MNCs in mapping their strategy for investment in India, complying with FEMA and other Indian regulations. He has also assisted MNCs in developing cost-benefit analysis, focusing on bilateral trade agreements and Carota rules. With in-depth knowledge of FTLs, he assisted Fortune 500 companies and India-listed companies in optimizing their benefits. Equipped with any advanced analytic skills, he has represented clients to DGRT authorities. With the diverse experience in economic laws, he has represented to government on various economics, politics through economic think tanks. He is regular speaker and his many articles are also published in newspaper and ICI journal. Now I welcome CA Chuk sir to take the sessions.
What a pleasant biodata that you have read, Aarti. Such a great biodata in such young times. You have got long times to go, Manas Chug, and you'll certainly make it very, very big. We're all proud of you. Over to you, and we're all eager to hear your presentation. Over to you, sir.
Thank you, Ardhaji, for the brief introduction, basically an elaborated introduction of mine. First of all, I want to thank Rajendraji and Nandaji for organizing this webinar and introducing me to this committee, to the Board of Internal Audit. I must, first and foremost, I must appreciate the efforts undertaken by Rajendraji. Under his able leadership, this committee has reached to a newer height, because internal audit, it pertains to a topic which is also very much into our blood of our profession, but because of different dynamic laws, different changes in the sectors, and where the processes are also changing like day on day basis, the first and foremost thing for the professional is to know the laws, know how we can improvise, because for a company perspective, going from 0 to 1 takes a different aspect, but going from 1 to 100, the first and foremost thing is the processes, where the internal auditor plays a very important role. So I must appreciate Mr. Rajendra Kumarji. Under his able leadership, this committee, this Board of Internal Audit has been taking to a newer height, and also he has been a guiding force to me. Because of his support, because of his guidance, I am been going forward in my professional career. I have not only from a technical perspective, but how to lead a life like a king size, like a size which Rajendra ji is already leading. So through him, I'm able to learn a lot during my whole professional journey. I hope this, specifically the guidance, continues in the near future too, sir. Because of your guidance, I'll make sure that I'll make you proud too. So coming to the topic today, as mentioned by Aarti ji too, the topic of discussion for today is understanding the international trade laws from the internal audit perspective. Basically, these are the laws which generally skips from the mind of a profession. When, for example, I, as a profession, goes for internal audit, the major concerns which I majorly focuses into, for example, supply side, purchase side, how the taxation is working. But apart from the taxation, there are different economic laws too. Economic laws not only governing the internal trade of India, like for example, PF, ESIC, and different other laws which is governing the internal trade of India or development of internal trade. There are specific laws which governs the international trade, and that generally goes into miss. If I give you a live example, which I also faced, we were undertaking an internal audit of a company recently, which was of a size of more than 2,000 crores of turnover. There, we found out they were missing out, they were having a revenue loss of more than 25 crores because the processes was not strong. They were not known to the laws. They were not known to the policies which are there under this international trade. So these are the stages, because until unless we as a profession don't value add to a company, they don't feel that a professional is giving their services. Until unless we don't give some value to them, until unless they don't feel that a professional is giving a service, they don't think that it should be rewarded well. So not only from the compliance perspective, not only from the audit perspective, we have to see how we can add value, how we can make sure that their processes are strong. We can make sure that whatever laws or regulations are there, or whatever benefits they can encash from what the government is giving, they should be provided for. So until and unless we don't know these regulations, we don't know what are the practical intricacies of these regulations, we will not be able to guide these companies well. So that was what the purpose of this today's webinar is, to make sure that the participants, to make sure the audiences who are already a well-qualified professionals, but there is a huge possibility that you don't know the nitty-gritties of these regulations. So that is why this webinar was organized. And I'll make sure that in the next 2 hours, all the regulations or all the important aspect of the international trade is covered, and I want it to be a interactive session. So whatever during the session you have any questions, you can just write it down, and I'll try to resolve it during the session itself. So I'll straight away share my screen now. So before understanding any regulation or any laws or acts that is being incorporated or come up by the government, the first and foremost thing to understand is to understand the objective of that act. What or why the government is coming up with this act, and what is the need of this act? Why this government is coming up on that day itself? So my objective of this session will be from understanding the objective, why there was a certain need of these regulations, and what are the current regulations, what are the practical difficulties, and how as an internal auditor we have to see that these companies are complying with these regulations, or we found out some observations in these regulations. So before understanding these regulations, I'll just brief it out of why this government, like the government focus came into on the international trade side. I believe like everyone must be aware of during the 1991-1992 crisis, the Indian government faced a balance of payment crisis. That means India itself didn't have much surpluses on the foreign exchange side. We didn't have any reserve on the foreign exchange. It was hardly 7 to 10 days of reserve we had. So what the government was forced to take loan from external agencies like World Bank and IMF and different agencies. When they were going forward with these loans, these specific foreign institutions mentioned that they will be giving a loan with certain conditions attached to it. The condition was majorly on liberalizing or opening up the Indian economy. Why this balance of payment crisis occurred? It occurred because we ourselves were not sustained, like our economy was not a sustainable economy. We ourselves, what we were producing, we were not able to consume, or we were not able to suffice the purpose of what the consumption was. So that is why we had to import. And that was a time when, for example, I had to buy a scooter. It took us around 18 to 24 months when I had to purchase a scooter. So that was a time when we didn't have any technology. They were a whole crunch on the foreign exchange side. So ultimately, the government had to liberalize their economy, had to come up with different acts to liberalize and look forward, have to have an open-minded thinking. So government came out with different acts, like FTDRA Act, which came in 1992. The government changed the FERA Act, Foreign Exchange Regulation Act, to FEMA, Foreign Exchange Management Act. The government came up with SEZ Act. The government came up with Foreign Trade Policy, and different other changes were made in the whole regulations. And there were different instances too, which were like, for example, because not only India, China was also opening up, Vietnam was also opening up. Different economies which are just beside our country were also started opening up. So government thought of until and unless they don't open up, it won't suffice. So wow, how the government came up with this idea, it was from the crisis, but how the government is building up, they are looking at to the opportunities. Like in the today's scenario, when the COVID was hit, whole country, not only the whole country, but the whole world was in the standstill, where everyone started claiming to China that there were different issues. So everyone came out with a new policy called China Plus One policy. China Plus One policy, because China is a manufacturing hub for the world. Every country, which, for example, India, Vietnam, Thailand, Malaysia, all these countries started a simple plan of China Plus One strategy. Not only India is benefiting, all these countries are benefiting. For example, if we talk about Apple, Apple has started manufacturing some of their mobile phones in India. So now in the current scenario, what is happening? The government has started focus not only towards exports, but also substituting the imports. Now their thought process is changing to substituting the imports into India, because we are hugely dependent on mobile phone electronic components, and crude cannot be substituted. Like it can be through, for example, ethanol and different areas, which also Indian government is focusing on. So what we have to understand from the professional perspective, we have to see that what objective the government is currently focused into, And according to the objective, all these acts and laws are made. So first and foremost thing is getting the objective right, getting how the government is government's thought processes, and accordingly we can, as a profession, we can see that these acts are framed accordingly. So this specific like PPT or slide mentions about the foreign trade in the last 10 years. This last 10 years, it is clearly evident that we were always in the deficit. Our merchandise exports has been constant around $300 billion for the last 10 years. In the last 1-2 years, it has increased from 350 to $400 billion. But in the last 10 years, it was constant to around $300 billion. So this is showcasing, even after so many changes in the laws, not only economic laws, but also taxation laws like customs, the government objective was simple, that they wanted to increase the exports. But with these all the objective, the objective was not fulfilled by what the government act was, because even after coming up with all the liberalized policies in the last 10 years, our export was constant, merchandise exports was constant around $300 billion. So now the government has realized that even after coming up with these regulations, it is still not working up. So now they've started changing these regulations, coming up with these new regulations, coming up with the new schemes. So because the ultimate objective is same, but now the directions are changed. So our today's objective will be how the government thought process is working on, what are the regulations and acts that are there under the international trade. Like in the case of international trade, the legislations that are governing the international trade are first the FTDRA Act, that is Foreign Trade Development and Regulation Act, which was incorporated in 1992, Foreign Exchange Management Act, which replaced FERA Act in 1999, Customs Act, that is in 1962, followed by Customs Tariff Act 1975, then Goods and Service Tax. GST and Customs Act pertains to taxation prospect, that is revenue prospect. But FTDRA, FEMA, Foreign Trade Policy, SCZ, all these acts are economic laws. That is, they're regulating or developing the international trade. They are not from the perspective of the revenue from the government, but how to regulate the international trade, or how to make sure that the international trade increases in India. So these are the 4 acts and the other ancillary acts which governs the international trade. Customs Act and GST Act governs from the perspective of revenue, that is how the government can encash from the import and export activity. So this is the definition of exports. The definition of exports in all the 4 acts are different. Like more or less it is the same, but the definition is framed differently. Like Foreign Exchange Management Act specifically mentions that it is the taking out of India to place outside India any goods or provisions of service from India to any person outside India. But in the case of Customs Act, it specifies that taking out of India to a place outside India. IGST also says the same, that taking a place outside India. And like FTDRA Act says that import and export means in relation to goods bringing into or taking out of India any goods or services by land, sea, or air. FTDRA Act doesn't says, it says taking out of, like FMI Act says taking out of India to a place outside India any goods. FTDRA says taking out of India. Now the question arises from the perspective of SEZ. If everyone is aware of the SEZ Act is an act which SEZ is an area which is inside the land of Indian land borders, but it is considered to be a foreign territory in India. Now the question that arises is, if for example I'm into a DTA, like I'm currently in a domestic tariff area, I'm selling my product to an SEZ area. Now the SEZ area, it is in India. It is not taking out, the goods has not been taken outside India. It is still in India, but the territory is considered to be an outside, like the territory is considered to be a foreign territory. So the issue that arises is whether that specific from selling DTA to SEZ is considered to be exports or not. So as per FEMA, I want to ask all the participants, so what according to you, do you think that it is considered to be exports, deemed exports? or some different definitions is there in this regard? Because first and foremost thing is understanding the provisions. So this is a question that has been in light and isn't been discussion of why when I'm sending my goods from DTA to SEZ, whether it is considered to be exports, and exports in all the four definitions, all the four acts, or only single, or only customs, or different acts. So this is the first and foremost thing that we have to understand, because Custom Act says that I'm taking to a place that is outside India. So in the case of SEZ, I'm sending to SEZ, it is not considered to be exports. Likewise, if I talk about the Customs Act in terms of import, for example, if I'm sending a goods from SEZ to DTA, whether it is considered to be import or not, that also we will understand in the future slides. So first and foremost thing is, when understanding the international trade, is the general provision. So who is the department or the ministry who is regulating the international trade? All the exports and imports is in India is regulated by DGFT, that is Directorate General of Foreign Trade. The regulation is being done by DGFT, which is under the Ministry of Commerce. But from the perspective of revenue, it is a Department of Revenue. Like that is, the Customs Act and GST is governed by the Department of Revenue, but regulations is regulated by the DGFT. So all the changes in the international trade on the revenue perspective is being done by Department of Revenue. On the regulation perspective is done by DGFT. So DGFT comes up with the notifications, trade notices, or circulars. For example, if I talk about recently, what they have done is they changed the policies of import and export. Like import and export in India, there are three regulations attached to it. One is either the goods that I'm exporting or importing is under the free category. Free category means that I don't have to take permission from the ministry or government or anyone to export or import that specific product. For example, if I want to export laptops from India, so when I'm exporting laptops, I don't have to take any permission from the government. But when I'm importing laptops, there is a recent change in the regulations by the DGFT. That DGFT mentioned when you're importing laptops, it is under the restricted category. Restricted category means that you can import, but import is only possible when you have to take the permission from the concerned ministry and DGFT. That is, for example, I want to import laptops, or I want to import tires. Tires also under the restricted category. If I want to import these goods, these specific goods, then it is under the restricted category. That means I can import. It is not that I cannot import. I can import, but I can import only after taking the permission or authorization from the concerned ministry as well as DGFT. Next is prohibited. Prohibited means I cannot export or import that specific product. Today itself, the government came out with a regulation on the sugar. That is, export of sugar is prohibited. I cannot export sugar in the current today's scenario because the government has prohibited the export of sugar. The reason, the government always come up with a reason why it is being, there is either in the restricted category or prohibited category. Like in the case of sugar, the government is thinking that the sugarcane production in the today's scenario is not sufficient to have to make sure that our internal consumption is met. So government doesn't want that it leads to some inflation or it leads to some supply side issues. So the government has straight away mentioned that the export of sugar is under the prohibited category, that you cannot, even after taking permission from the ministry, you cannot export the sugar. Third is state traded enterprise. State traded enterprise means only the selected state traded enterprises, that is the PSUs, can deal into that specific import or export of that specific product. So we have divided the whole goods into four parts. One is free category. 99% of the goods are under the free category. That means you don't have to take the permission on the export or import of the specific product. Second is restricted category. Restricted category means you have to take the permission from the ministry when you are importing or exporting that specific product. Third is a prohibition. That means you cannot import or export that specific product. Fourth is state traded enterprise. That means only the PSU or specific trading enterprises can deal into the specific product. Next is the IEC. These are the general regulations that we are understanding. So when, for example, in the case of IEC, this is also a very important thing that when we as an internal auditor have to understand. When I as a corporate or I as an individual have to undertake an activity of import or export, the first and foremost thing is I have to get an IEC, that is Importer Exporter Code. IEC is the first thing that an importer or exporter has to take, because like without the IEC you cannot import or export any product. So IEC is a mandatory document when you are undertaking an export or import activity. The recent regulations that they have changed by the DGFT is that ISC has to be updated each and every year. That means you have to update your IEC each and every year, because there are different instances that the government has faced, that numerous companies have taken the IEC, but they are not into existence. So what they have done, the ministry has done, the DGFT has provided a notification where they have prescribed that if you have to take an IEC, then you have to update the IEC each and every year. So many companies don't update the IEC. So first and foremost thing is that you have to get the IEC updated each and every year. IEC also has to be linked to the MCA. What the MCA is saying, like for example, what my directors are in the MCA, how many sites or how many locations I have in my GST, everything has to be updated in my IEC. Because, for example, if my IEC is not updated, and for example, if my manufacturing site is not there in the IEC, then what happens when I'm importing? Then the customs can create an issue that this specific branch is not in your IEC, so you cannot import into that specific location. So IEC has to be updated in such a manner that whatever GST is showcasing, whatever your MCA is showcasing, everything the same has to be showcased in the IEC number. Next is the RCMC. When, for example, I have to take any benefits of the government under the foreign trade policy, first document that I have to take is the RCMC, that is Registration Cum Membership Certificate. I have to take the RCMC from the Export Promotion Council. There are around 35 export promotion councils for each and every product. For example, for textile, there is AEPC, that is Apparel Export Promotion Council. For service, it is Service Export Promotion Council. For engineering, there is Engineering Export Promotion Council. So for each and every product, there is a separate promotion councils. And if your product is not falling under any of the promotion councils, then there is a FIO, that is Federation of Internal Export Obligation. Basically, FIO objective is, if you're not falling under any promotion council, then you can take the FIO membership. RCMC is taking the membership of an Export Promotion Council. So when you're taking the benefit of any of the foreign trade policy benefits, then the RCMC is the most important document. So RCMC also has to be updated each and every year. There are numerous cases that the RCMC is not updated, and when it is not updated, you are not eligible to take the benefit under the foreign trade policy. So it has to make sure that in the processes of the international trade, we have to specify that RCMC is updated each and every year before the closing. That means because RCMC is issued for a particular financial year. So before the closure of the financial year, it has to be mandatory, updated and mandatory renewed. Next, these are the mandatory documents which are there under the import and export category. For the export, it is bill of lading, AB bill, postal receipts, commercial invoice and packaging list, shipping bill, bill of exports. In the case of import, it is bill of lading, commercial invoice and bill of entry. So bill of entry and shipping bill is the custom documents. It is the document through which a company is able to recognize and see what is the obligation on the revenue side. That is, when I am importing a specific product, for example, I'm importing laptops, I have to file a bill of entry with the customs. When I'm filing the bill of entry, I have to specify what is the HSN code, what is the description of the product, what is the quantity, what is the price, and on that price is also can be FB value, can be CIF value, and on the CIF value, the duty is calculated. That is, the assessable value has to be we have to calculate the assessable value. On the assessable value, we have to calculate the duty. So bill of entry prescribes like what exactly is the duty that the importer has to pay to the government. It can be BCD, that is basic custom duty. Then it can be cess, that is SWS, social welfare surcharge. Next is GST, that is goods and service tax. And there can be other taxes too, which can be like anti-dumping duty, safeguard duty, or countervailing duties. These can be there can be possibility that a company has to pay the anti-dumping and different other duties too when they are filing the bill of entry. So when we as an internal auditor are checking the processes, we have to see that how this duty calculations is being undertaken, and when the duty calculation is being undertaken, whether the duty that is being taken by the government, it is in line, either there is either a like a circular or a notification by the government which is giving some kind of concessions on the import. That we'll be understanding in my future slides, that what all concessions can be there and why these concessions are important, and from the internal audit perspective, what we have to check when we are checking these specific regulations. So these are the important things that we have to see when we are understanding the mandatory documents which are there under the import and export. So now the next question that arises is, I received one question from Mr. Villanueva. For supply of services like teaching foreign students through video conferencing, is IC and LUT a must? Please clarify. So what the regulation is saying? Regulation is simple, that when you are importing or when exporting, you have to take the IC, that is importer exporter code. Now the question that arises is, when I'm exporting, for example, I'm exporting accounting services. So whether the IC is mandatory, the question is, it is as per basically what happens is when I'm exporting or importing goods, in that scenario, the customs checks my IEC. The custom is checking that under this IEC, this product is being imported or exported. But when I'm exporting, for example, accounting services, no one is checking. What I have to do is I have to just render the services by sitting at my office, and for example, through telephonic, through laptops, I'm just rendering the services, and automatically I raise the bill under maybe LUT. I raise the bill and I get the payment. After the payment I've received under the dollars, I have to pay. I have to like submit the documents to the bank that this specific foreign exchange is being received under this specific invoice. Now the question that arises is, here in this scenario, IEC is not being asked by any of the government authority. That is, IEC is not being asked by RBI. IEC is not being asked by customs. So it is recommended that IEC should be taken by the service exporter too, because in the different schemes, like the service exports from India scheme, there was a scheme called SCIS for the service like exporters. There was a mandate that if you are taking the benefit of SCIS, you should have the IEC as on the date on which the services were rendered. That means the date on which you were rendering the services, the IEC should be there. Then only you are eligible to claim the SCIS incentive as on today. So as per the regulation, it is not mandatory, but it is recommended that for a service exporter, they should take the IEC too. So I hope the question, your question is answered. Next is the provision on the denomination of invoices and remittances. Now the question that arises is, when, for example, I want to export, be it goods or services, can I do it in any currency? Can I do it in INR? So the regulations that is there is specifically which is there for the import and export, that the export contract or invoices can be any in foreign freely convertible currency or Indian rupees. That is, the invoices and contract can be in both, either in Indian currency or freely convertible currency. There is no restrictions on the invoices, but the export proceeds, that means the remittance of that export, has to be only in the freely convertible currency. That means invoices can be in Indian rupees or freely convertible currency, but the receipt or the remittance of that export has to be only in the freely convertible currency. There are many instances when, for example, I have like, for example, a French-based multinational company has a subsidiary, wholly owned subsidiary in India. So the Indian company wants that, like, regardless of the foreign exchange, I want, for example, 10 lakh rupees for this specific export. So the Indian invoice mentions that 10 lakh will be the export, like the 10 lakh will be the remuneration of this specific export. Now, the person who is the buyer, he has to pay in the foreign currency. He cannot pay me in Indian rupees. So he has to pay me in foreign currency, but it will be received in such a manner that 10 lakh is received in my bank account. So there are many instances that the invoices is raised in Indian rupees, but the payment is realized in the foreign currency, that is freely convertible currency. So invoices can be raised in both the scenarios, that is freely convertible currency and Indian rupees, but the realization has to be in freely convertible currency. In the recent change, what the government has come up with, what RBI has made the change is that you can settle, that means the invoice, which was already allowed in the Indian rupees, but the settlement of export and import can also happen in Indian rupees. This was a very recent change by the RBI, where the RBI has allowed, it was hardly 6 months back itself, that what the RBI has done, RBI has allowed that the payment, that means the settlement of this of the export and import, can happen in Indian rupees. So now the question arises that can all the import and export, for example, I'm sending my goods to Australia or exporting my goods to USA, can I realize it in Indian rupees? No. The RBI has changed the regulations, but they have come up with the conditions to it. That is, the condition that is there is, it is only for specific countries currently in the current scenario, because what the regulation says, it says that invoicing can be in Indian rupees, settlement can also be in Indian rupees, but the settlement which has to be there, it should be routed through a Vostro account, that is rupee Vostro account, and the rupee Vostro account has to be opened by the foreign country's bank with Indian country's bank. For example, Russian's Sabar Bank has to open a Vostro account in India with, for example, Yes Bank, SBI, or some bank, and all these transactions will be routed through that account only. So I cannot deal and settle my import and export transactions in Indian rupees with all the parties. It is allowed, but it is allowed with very selected countries. The objective of the government was, when the government came out with this policy, was because the at that time there was a Russia and Ukraine war. India and Russia, it's a very big international trade partners. They have a very numerous size of exports and import activity being undertaken, and Russia was being sanctioned in different ways. And the major way was that they cannot, the foreign exchange they had, it was not of it was discarded. So when we were dealing with Russian countries, with Russian companies too, we had to make sure that I'm exporting to Russia, but I was not able to get the remittances because Russia didn't have much foreign exchange reserves. So through this specific mechanism which the RBI has come up with, now I can deal with Russia in Indian rupees. So many of our foreign clients, many of our multinational companies and Indian companies in India, they've now started exporting to Russia and getting the realization in Indian rupees, but make sure that all the Indian rupees is not allowed. That means I cannot receive the Indian rupees directly to my bank account. It has to be routed through a rupee Vostro account. That rupee Vostro account is being maintained by the foreign bank with the Indian bank, and the amount is routed through these banks. So until unless it is not routed through this mechanism, I cannot deal and settle my invoices in Indian rupees. I hope it is clear to all of the regulations that is changed by the RBI. That means it is allowed, settlement of import and export in Indian rupees is allowed. The invoicing was allowed in the previous scenario itself, in the previous regulation or the erstwhile regulations. But what has changed, the settlement can also be undertaken in Indian rupees, but it can only be routed through the rupee Vostro account, and the rupee Vostro account can only be opened by the foreign bank with the Indian bank, and with the permission of the RBI. So any questions till now, you can ask me in the chat box. I hope the provisions is clear on the denomination of invoices in the remittance. That means the denomination of invoice can be in Indian rupees or foreign convertible currency, but remittance has to be in foreign freely convertible currency. Remittance can be in Indian rupees too. That means the settlement can also happen in Indian rupees, but the condition is it has to be routed through the rupee Vostro account. Other changes that is being there is that means advances against the exports, setting of the export receivables. That means import and export can be settled set off, but it has to be the conditions is there. Now also the rupee surplus balance is also there is a specific condition for the rupee surplus balance, which I will not go much into details, which is because it is not much of relevance for the professionals. So now the question that arises is that first thing that we have understood is the regulations. That is, what is the general provision under the free category, provision, prohibited, restricted, or different categories. Next is the denomination of the invoices and the remittance. Next is the period of realization. That means in how much time period I have to realize my exports. Foreign Exchange Management Act 1999 specifies that if I'm exporting from India, then I have to realize within the 9 months time period. That means within the 9 months from the date of the export, I have to realize that amount. Next question that arises is, like, do I have additional time apart from this 9 months? That means 9 months is allowed by the government under the Foreign Exchange Management Act. So are there other, for example, are there other time period or extension that is can be allowed? So yes, extension can be allowed, and the extension is you can go to the RBI, you can go to the bank, AD bank, and ask for the extension. Extension can be allowed up to 6 months at a time. That means it is allowed for n number of times, but up to 6 months at a time. So when I'm going to the RBI or bank for the extension, I have to justify why my payment was not realized, what all efforts I'm doing to get the realization, and then only the government or the RBI gives me permission for the extension. Now, because I have this is for normal exports. Like for example, I'm exporting from DTA, I'm exporting from SEZ. Anywhere in India, I'm exporting to an outside territory, that is exports after realized within the 9 months time period. Now, the next question that arises is, if for example, I have a warehouse set up outside India. Warehouse set up outside India means that not only any warehouse, for example, there is a warehouse of, for example, in Dubai, if I talk about, there is a private warehouse, ownership is also with a Dubai company. So whether I'm exporting from India to that warehouse, can I be allowed some extra time? No, the timeline is the same, that is 9 months. But when I, as an Indian, have a warehouse set up outside India with the permission of the RBI, then I have 6 months extra time period. That means 15 months time period is being given to me to get the realization of the exports. So why is this extra time given to the warehouses? The extra time that is given is the purpose of the warehouse. What is the purpose of the warehouse? The purpose of the warehouse is that I'm exporting it in bulk, but my product will be sold there in that territory in, for example, pieces. It will not be sold as a whole bulk, but it will be sold in pieces. So the government in this scenario has given 6 months extra time period. That means you can export to a warehouse outside India, and you have to realize within a 15 months time period. So where in the practical scenario do you generally see this scenario? It is generally seen in the e-commerce. For example, if I talk about in companies which are basically e-commerce companies, what they do is, for example, if I am into garment, I have a garment e-commerce website. For example, for individual garment or individual shirt, if I export to US, it will be a very costly affair to me. So what do I do is, I'll open a warehouse outside India. I'll send my whole bunch of product that is generally sold in 1 month or 15 months time period to that warehouse, and through that warehouse I sell it in the domestic market. So these are the general in the general parlance. E-commerce companies generally have these issues where have such warehouses set up outside India, and the government has given 15 months time period to realize when you're exporting to your own warehouse, which is set up under and with the approval of the RBI. So I hope now the like before understanding the advance payment, I'll make you understand what exactly is EDPMS and IDPMS system. I want anyone from the participant, if you can write in the chat box, if anyone knows what exactly is EDPMS or IDPMS system. Anyone from the participant? What do you think is the EDPMS or IDPMS system? So when I'm understanding the regulations of these international trade, there is a very important software which the government has built, which is called as IDPMS and EDPMS system. EDPMS is for exports, IDPMS is for imports. EDPMS, the objective of the EDPMS system is when I'm exporting from India, I'm exporting through the customs. I'm filing the shipping bill through the customs and it is being exported to the specific destination. Now, the question that arises is how I am mapping it with the realization, because the government has said, as straight away mentioned in the FEMA Act, that you have to realize within the 9 months time period. But the question that arises is that how come the government is able to see that you are realizing it in the 9 months time period? So the EDPMS system was built wherein when I'm exporting from India, the shipping bill is filed, the shipping bill automatically from the customs is reflected in the EDPMS system. EDPMS, whenever I'm exporting, the EDPMS system says that this specific product was being exported at this specific quantity and price. So EDPMS system mentions about the exports. Now, when I have realized that amount in my bank account, I have to go to the bank and say that with this, like pertaining to this invoice, pertaining to this shipping bill, I have realized this much amount, and you can knock off that entry in the EDPMS system. Because in the EDPMS system, when you will go to like for example a company which is into the international trade, first and foremost thing is you have to take the IDPMS and EDPMS pending entries from the company, because on that perspective you will be able to understand like what all are the like the exports or imports which they have undertaken. The payment or the realization is still pending. So when you are undertaking exports, EDPMS automatically reflects that entry that you have undertaken that exports. Next step is when I'm realizing it, I have to go to the bank and I have to say that with respect to this invoice, with respect to this shipping bill, I have realized, kindly knock off that entry in the EDPMS system. So when I'll go to the bank will issue me a BRC, that is bank realization certificate, and knock off that entry in the EDPMS. That means I have undertaken the export and realized it in the like the time period that is allowed under the Foreign Exchange Management Act. So from the internal audit perspective, first and foremost thing is you have to take from the company the IDPMS and EDPMS pending entries, according to which you will be able to understand like what all are the areas or what all are the entries, that is exports or imports, in which you have either they are not made the payment or they are not realized it within the time frame which is allowed under the Foreign Exchange Management Act. So I hope it is clear what exactly is the IDPMS and EDPMS system. Now, the important thing and very important thing from the internal audit perspective is the advance payment. There are many numerous cases wherein I have to export, but before exporting, what I have done, because I have to safeguard myself, because for example, I don't know the party. I don't know the party to whom I'm exporting. So what do I do? What I generally do is I take an advance from the company, from that buyer, maybe 50% advance, maybe 25% advance, or maybe 100% advance also. I take it up as an advance, and according to the advance, I make the exports. Now the question the FEMA Foreign Exchange Management Act mentions that if you have taken an export, if you have taken an advance payment under which your obligation is to export, then within 1 year time frame you have to make the export. That is, after receiving the advance, within 1 year time period you have to make the exports. If you're not able to, then you have to ask the bank, you have to take the permission from the bank that you're not able to realize it and you are not able to export it within the 1 year time frame. Next is, if for example I have received an advance within 1 month, within 1 year I was given within 1 year I had to export the specific product, but for example I'm not able to. So what do I have to do? For example, the buyer has requested me to the buyer is requesting to make sure that the buyer is saying to refund back the advance that he has given to us. So what in this scenario, what happens when the 1 year time frame is elapsed? After the 1 year time frame, if I have to refund back the advance payment which I have received for the export, then I have to take the permission from the RBI. It is a very important regulation, and this leads to many breach in the different companies, wherein, for example, if I as an auditor have to verify, I have to see if an export advance has been given and export advance within 1 year time frame, company is not able to export, and the company is saying that I have to refund back the advance, then in that scenario the company has to take the permission from the RBI. In the case where within the 1 year time frame, for example, I have received an advance, within 6 months I'm not able to fulfill the order, so within the 6 months I have to refund back. So for example, I have to refund back within the 6 months, then in that scenario I don't have to take the permission from the RBI. I would take the permission from the RBI only when it crosses the 1 year time frame. That is, after crossing the 1 year, I have to take the permission from the RBI that when I'm refunding, then the bank will not allow me to refund back. Bank will ask me to take the prior approval from the RBI. Then only I will be able to refund back that amount of the advance that I've received for the exports. I hope it is clear to all that what is the time frame within which I have to realize that exports, how the EDPMS and IDPMS entries are working, and why it is very important software. Next is the advance payment. I've already briefed this specific slide. For example, the 9 months time frame was being allowed under the FEMA, that is, and in the 9 months time frame you have to realize the exports proceeds. But for example, if I'm not able to, for example, the export party is not giving me funds because the export party is not into a good financial position. It is about to declare solvent. There are some financial difficulties being faced by that company. So in that scenario, the extension can be applied. I can apply it to the bank because, for example, if I've not, for example, within 9 months time frame, I've not received the remittance, then before the 9 months time period, I have to apply to the bank that I am not able to receive the amount because of such justification or reason. Kindly allow me 6 months extra time frame. So what the bank will do, bank will give me 6 months extra time, and that too at a time. It is not that I can ask directly to the bank that give me 3 years to give me additional 3 years. They will give you 6 months at a time, but after every 6 years I can go back to the bank and say that give me another 6 months. But bank will always ask for the justification that what is the reason that you're not able to get the realization. What are the steps that you have taken to not what are the steps that you have taken to get the realization? Also, the bank says that there should not be any investigation undertaken by the ED or CBI or other investigation agencies. The AD category bank should also be satisfied that the exporter has not been able to realize the export proceeds for reason beyond his control. The exporter submits a declaration that the exports proceeds will be realized during the extended time frame, because when the bank will be giving me extended 6 months time frame, I will be giving some kind of undertaking to the bank that I will be getting the realization within the next 6 months time frame. But there are huge instances or numerous instances that after the 6 months time frame too, I'm not able to realize it. I can go back to the bank again and take the permission all for the extension. Bank will come up with the same saying that you have to give some justification to it that why you are not able to get the realization, or there are some reasons which are beyond your control, that is why you're not able to get the realization. Definitely, Rajivji, I'll share across to you the PPT. In case any questions you have during the session, do ask me during the session itself. So and also when I'm extending the beyond the 1 year time period, I'm have to extend, then the total outstanding of the exporter should not exceed USD 1 million or 10% of the average export realization during the preceding 3 years, or whichever is higher. That is, they have mentioned the conditions to it, that how much, or for example, how much you can apply for when you are like going forward with the extension of the remittance for the exports. The bank, when they will be receiving our application, the bank, what the bank will do, because I have not realized within the 9 months time frame, then in the EDPMS system, this specifically will be showcased in the as a pending entry, because I've not realized it. So what the bank will do is, bank will report it in the EDPMS system. That means they will update the EDPMS system and they will extend the time, because otherwise what will happen, I'll start receiving automated emails from the RBI that within the 9 months you have still not realized that amount, and it is leading to non-compliance under the Foreign Exchange Management Act. Next and foremost, a very important regulation is the third party payment. So what exactly is third party payment? Third party payment means that, for example, I am exporting to China, but I'm getting the realization from USA. It is simple that I'm exporting to China, but I'm getting the realization, for example, from USA or from Dubai. It is simple that I'm exporting, like just like bill to ship to, I'm billing to someone else, but I'm shipping to someone else. Here also, I'm sending it to someone, but I'm getting the remittance from someone. So why this specific issue can arise? And it is a very important issue where different companies faces, and because of which there is a numerous pending entries in the EDPM system. So so the background of it is, when, for example, you are exporting, you have to specify who is the buyer of this product. You have to specify in the shipping bill that who is the buyer of this specific product. So when you specify, for example, I have specified that Arunji is the buyer of this specific product, then in this scenario, where I have to realize that amount from Arunji itself, because in my EDPMS system, what will be reflected? It will be reflected that I have exported to Arunji this is much amount. Then I have to realize it within the 9 months time frame. Now, for example, I exported to Arunji, but I'm getting the realization, for example, from Dubai, or getting the realization from for example, from USA. Now, in this scenario, I've exported to for example, Arunji, but I'm getting the realization from someone else. In this scenario, my EDPMS system will still reflect that entry. My EDPMS system will still showcases that this specific export you have still not realized, but actually I've realized it from someone else. So the government, and it is in the general parlance that like there are many instances that the company like generally export to someone else and get the realization. Or for example, I'm exporting to a subsidiary company of a holding company and getting the realization from a holding company. So it is very much in the like in the international trade scenario, it is very much like predominant where this scenario function. So bank has mentioned that you can undertake this transaction. The RBI and the FEMA Act says that you can undertake this transaction, but because there will be procedural issue, because in the EDPMS entry, it will not be getting knocked off. And also generally what happens is like it leads to different misappropriation of the funds too. For example, it leads to Hawala transactions. Like for example, I've exported to USA, but I'm getting the funds are routed through, for example, Dubai. These are very much prevalent in the India's today's current scenario. So what bank sees that when you are exporting to someone, the realization is also from the same party. But if the realization is not from the same party, then I have to follow the regulation which is there under the FEM Act. So what exactly is the regulation? First, there has to be a tri-party agreement. It means between the three parties, it means I, the borrower, the buyer, and the person who will be making the remittance. All these three parties should have a tri-party agreement and with the obligations. That who has which obligation? That means I have an obligation to export this good at this specific time frame. Like for example, this specific buyer will be the specific buyer. The shipment will be going to, for example, US itself, but the obligation of the payment will be with the Dubai party. There has to be a tri-party agreement between the three parties, that who will be the buyer, who will be the seller, and who will be the person who will be making the remittance. Now, after the tri-party agreement is being made, I have to showcase it. I have to showcase that tri-party agreement to the bank. These are all before undertaking the transaction. It is not that after undertaking the export transaction, I will go to the bank and say that this specific remittance belongs to this specific shipping bill. It will not be the case. It is before the transaction is being undertaken. I have to go to the bank and say that for this specific export, which I will be undertaking in the next 1 month, I'll be getting the remittance from this specific party. So what bank will do? Bank will see that the transaction is bona fide. That is, a bona fide transaction has to be there. It should not be the case that it leads to manipulation of funds, or leads to just routing of funds. Like in cases of different companies which are there in African countries faces different issues because they don't have much foreign currencies or freely convertible currencies. So what they do is they route their amount through Dubai. So the major concerns, what I have also practically seen, is that this third party payments is practically only seen when I'm exporting to countries which are basically African countries, because the funds are being routed through Dubai or UAE or different countries, Middle Eastern countries. So the bank will see whether he finds out that the transaction you will be undertaken, whether it is a bona fide transaction or not. The all transaction has to be done through a bank channel only. Export declaration form, when I'm filing the EDF, that is export declaration form, and when I'm filing the shipping bill, I have to mention that who is the exporter, that is I, who is the importer, that is who is the buyer, who is the consignee. Consignee means who will be ultimate the person who will be making the remittance. So all these three parties has to mention in the shipping bill. Then only the bank will be able to see and then knock off the entry which is there under the EDPMS system. Apart from it, there are different other conditions attached to it. That is, I cannot make a shipment to a restricted category countries like Sudan, Somalia, or different countries which are under the restricted categories, or through category which Indian government feels that there can be a political issue, there can be economic issue with these countries. So there are other conditions which are there. So the major conditions which is there is that you have to get the tri-party agreement between these three countries. When you are filing the shipping bill and the EDF, then you have to mention the buyer, the seller, and the consignee. The consignee has to be the person who will be making the remittance of this specific exports. So I hope it is clear to all. In continuation of my earlier question, I've received one more question. In continuation of my earlier question on supply online education to a certain number, what is are the line items I should consider while raising exporters? Generally, like when I'm exporting, I generally raise a zero rated invoice that is under the LOT, because you don't have to take you generally don't have to go forward with first making the remittance of, or making the the GST payment, and then refunding that, like going forward with the different process. It is always better in majority of the cases. In the case of service exports, what the companies generally do is they sell it in the zero rated supply and without payment of the duty. That is under the LUT, that is under the letter of undertaking, I make the exports, and that is, I don't have to charge the GST and I can just export it. So I hope it is clear to all what exactly is the third party payment. If in case anyone has any questions related to what I have discussed till now, you can ask me in the chat box. Next and very important case is the write-off. So what exactly is the write-off? For example, if I as an individual or I as a company want to sell a specific product from Delhi to Chennai, I'm sending that under, for example, what I have to do is I'll raise an invoice, I'll file the e-way bill, I'll make the requisites which is there under the GST Act, I'll load the specific goods in the truck. The truck goes to the Chennai and the unloading is being undertaken in the Chennai. Now, in the Chennai, when it is received in Chennai, the Chennai buyer finds out that the specific product was not up to the mark. That means there were different quality issues. There were changes. For example, the person ordered 100, but it was delivered only 95. There were different leakages during the transit. So 5 was not received by the Chennai buyer. In this scenario, because it is a transaction which is there in India itself, the whole transaction is being undertaken in India itself. So in this scenario, what will happen? The in this scenario, because there was some quality issue, there were some issues in regard to the quantum. Then in this scenario, debit note or credit note is being raised. A credit note is being raised when there is, for example, reduction in the invoices. So it is very easy in the case of GST when the transaction is incurred within Indian landscape, that for example, there is a change in the pricing, there is a change in the quality, there is some issue in the pricing. Then by raising debit notes and credit notes, you can settle the case. But it is not the case when I'm dealing in the international trade. For example, I exported a specific product. For example, I exported 1,000 mobile phones to USA. When I exported 1,000 mobile phones to USA, the amount that was involved is, for example, $1 million. But when I exported, the foreign party said that out of 1,000, 950 was right, but 50 was the quality. There was some quality issue. It did not meet the optimum quality issue which was there. Or the export, basically the buyer was not willing to pay me. There is a possibility that buyer is not willing to pay me. So in that scenario, only the debit note, credit note not only fulfill the suffice the purpose which is there, because in this scenario the foreign exchange is involved, the RBI is involved, not only my own funds is involved, but the government fund is also involved, because the foreign exchange is involved in this scenario. That is why in this case, in the case of international trade, when there is a write-off, then in that scenario, you have to take the permission. Where, if, for example, in the preceding calendar year, if I talk about in the scenario which I've given in regard to the mobile phones, the export was for example, for $1 million. But he made the remittance of only for example, $0.9 million. In my EDPMS entry, it will be mentioned that $1 million was exported. In my when I'll submitting the documents to the bank, I'll say only $0.9 million is being received by me. So for $0.1 million is a pending entry in my EDPMS system. Now the question arises whether, because the buyer has straight away said that he will not give me funds because there was some quality issue, that he don't want to give funds, or different issues which is involved. So in that scenario, a write-off has to be done. That means I have to write off that amount because I will not receive that export invoice. So what the FEMA Act says, whatever exports that you have realized in the preceding calendar year, not the financial year, in the preceding calendar year, whatever export that you have realized, 5% of it you can 5% of it you can write off under the self write-off basis. That is, you can write off on your own. Even if you are writing it off on your own, it is not that I have to just write a book entry, that I have made some debit note, I have just made a accounting entry in my books of accounts and the write-off is done. I have to inform the bank. That it involved a write-off, that it involved because of such a reason, because of such a justification, I was not able to realize that amount, and because of that, I have to write off. So within the 5% time frame, 5% limit, if it falls under the 5% limit, then the bank will not ask any question. Bank will just ask a justification, and you can write off. And accordingly, bank will update it in the EDPMS system, and that bank the entry in the EDPMS system of pertaining to specific shipping will be knocked off. In the case of status holder is a specific certificate which is given under the fund rate policy. So if a person is a status holder, the limit is increased from 5% to 10%. And for a general person who is not a status holder, 5% is being allowed under the self write-off. 10% is allowed by the bank. That means 5% is allowed by my own self. 10%, that is above 5% to 10%, is being allowed by the bank. Above 10%, I can do it, but with the permission of the RBI. In that scenario, I have to take the permission from the RBI when I have to write off the export proceeds, write off the exports which I'm not able to realize it. In the case of RBI too, RBI doesn't give the approval like easily. RBI asks numerous questions in this scenario of what all efforts that you have taken, whether you have filed any court case against the company, whether that company is under the insolvency, whether there is solvency issue in that company, or whether the whole territory, for example, I've exported to Russia, and Russia whole territory is facing some kind of issue. Whether, for example, I've exported to Ukraine or I've exported to Israel, and because of the whole territory is facing some issue, I'm not able to realize it. So when there is justification attached to it, then only the RBI gives some permission. Otherwise, first RBI then ED starts sending you notices that there is a non-compliance with the FEMA regulation. Because what happens in the journal, like it is a practical scenario. What happens when I exported, for example, $1 million. I received only $0.5 million. $0.5 million I received in cash, that too outside India. I did not receive it through the bank account in India. I received it in cash through outside India. In that scenario, what will happen? $0.5 million will still show in the EDPM system. Now the bank will say that what is the reason, and that scenario you don't have a justification to it that why this amount was not received, because the amount was received, that too in the cash scenario, rooted like maybe outside India. Because in that scenario you cannot file a suit against the company, you cannot file a mail, you cannot give some justification or evidence that this is the reason. So the purpose of this specific regulation is you can do it. Write-off is allowed, 5% is allowed under the self write-off, 10% for the bank, above 10% is allowed, but with the permission of the RBI. You have to give the justification to the RBI that why it is you are not able to realize that amount. I've received one question from Rajkumar ji that how to account for and raise bill of entry in case of import of machinery from USA, and on arrival during installation it is found one part is defective and supplier is ready to replace that part free of cost. So it is a very important practical issue what is being faced, that for example, I've imported a machine, and that machine which is imported, some part of it is basically defective. So now the foreign seller has mentioned that he will replace that specific part free of cost. So for example, for example, that specific part is being imported into India, I have to file the bill of entry. When I'm filing the bill of entry, I have to specify that this is the assessable value. When I will be specifying that this is the assessable value, according to which the custom officer will come and say that this is the assessable value and you have to pay the custom duty on it. But in this scenario, because it is a replacement and that too free of cost, because I don't have to make the payment out of it. So in this scenario, when I'm filing the bill of entry, what I have to do is I have to mention the notional price of that invoice, notional price of that specific part, but I have to mention that in the bill of entry there is a specific, when I'm filing the bill of entry, there is a specific sections to it when I have to say and I have to highlight that it is imported free of cost as a replacement. There is a specific, when I'm filing the bill of entry, there is a specific section in it of when it is imported free of cost, I have to specify that this is imported free of cost. So when it is imported free of cost, my EDPMS system will automatically say that this product was imported by, for example, Mr. Rajkumar, but this product was imported free of cost. So therefore, the IDPMS system will also not reflect that it is a pending entry, because the payment has not, there is no need to make the payment because it was imported free of cost itself. So in this scenario, Rajkumar ji, I hope the question is clear. The answer is clear to you. When you are filing the bill of entry, there is a specific section in which you have to say that this specific bill of entry, it is imported free of cost as a replacement. So accordingly, the IDPMS system will also reflect that it was imported duty free and also free of cost. I hope Rajkumar ji, your query is clear. Next is that I believe everyone is clear with the write-off of the provision, that what exactly is the provision for the write-off. Like I've told, there is specific conditions attached to it. It is not like just I apply it to the RBI or I apply it to the bank and the bank gives the permission. Bank takes some documentary evidence. Bank will ask why you're not able to get the remittance, what are the steps that you have undertaken to get the remittance, whether it has been declared insolvent, whether the Indian embassy is involved in this whole process, whether the product was destroyed in the port, whether the buyer is not traceable, and whether I've taken some legal action to it. So in this scenario, I have to give some justification or documentary evidence of why I'm not able to get the realization. So from the internal audit perspective, what I have to see, first I have to check the IDPMS and EDPMS pending entries. When, for example, recently itself, I was we were undertaking an internal audit of a company which is into sanitary ware. What happened in their scenario? They exported a product which belonged to 2019, and still not they have not realized that amount. They didn't ask the bank for the extension of the time frame, because 9 months was the time frame, but they didn't ask the bank for the extension. So what was happening? That it was showing in the debtor list. The EDPMS system was mentioning that it is still a pending entry. So in that scenario, I or we as an internal auditor have to make sure that the process the company has, there should be a specific clause for each and everything. And for example, if there is extension that is required, you have to say that this, like if there is extension, what do you have to do? If there is unrealized export invoices or that involves write-off, then in that scenario, what do you have to do? So the objective of the today's scenario was, today's webinar was also the same, to understand the regulations attached to on the international trade scenario. So I hope the write-off provision is clear to all, that what exactly in the case of when we are undertaking a write-off of unrealized export invoices, what I have to do, I have to submit it to the bank when it is it is above the 5%. 5% of what is allowed, and above 5%, above 10%, I have to go to the RBI to take the permission. Next is reduction in the invoice value. This is also very important case when, for example, I have exported. For example, I exported, for example, for $1 million, or for example, I exported for $100,000. But when that invoice was received, when the product was received by him, they thought, or they observed, that some part of it was destroyed, some part of it was not up to the quality mark which they had. So in that scenario, there is a need for reduction in the invoice. Of, for example, I had mentioned in the Indian perspective, when I'm dealing with Indian companies, I'm selling it from India to China, India to, for example, Chennai. I just have to raise a debit note or a credit note, and it fulfills the purpose. But in this scenario, when I'm exporting it or exporting it, basically, then when, for example, I have to reduce the invoice value, then it is not just like I have to raise a credit note and it fulfills the purpose. I have to ask the bank, I have to go to the bank, and if I need some reduction in the invoice value, it is allowed, but up to 25% of the invoice value, I can go forward with the reduction. And that too, I have to have there are certain other conditions attached to it. That is, the exporter should not be in the caution list. Exporter should pay back whatever export incentive he has taken. Excuse me. The exporter has to surrender whatever export incentive he has taken. The bank will see that it is on the genuineness. It is a genuine request. It is a bona fide request being given by the exporter. Then only in that scenario, the government, the RBI and the bank gives and allows reduction in the invoice value. Otherwise, bank also doesn't allow. So whenever there is a reduction in the invoice value, it is not like just I make an accounting entry or just make a credit note or debit note and it fulfills. I have to go to the bank. I have to fulfill the regulations which is there either in the write-off or in the reduction, which is there under the FEMA Act. Then only the bank will allow, then only the bank will, because everything is routed through the EDPMS system. If the EDPMS system is saying it is a pending entry, then it is that you are not fulfilled, then you are not fulfilling the regulations which is there under the FEMA Act. So we have to see as an internal auditor that the regulations is being complied with very well by the company. Next is refund of export proceeds. Refund of export proceeds means, for example, in this two scenarios what we have discussed previously, it was write-off. Write-off means that I didn't receive any amount. Second was reduction. That means between the two companies, they decided that 25% or maybe 20% reduction of, for example, $100,000, 20% of reduction has to be there in the invoices. Remaining will be paid by the buyer. So in that scenario, I'm getting the remittance. In the case of second point, in the case of one, I'm not getting the invoice, I'm not getting the remittance, so I have to go to write off. Third is I have received the export proceeds, but I have to refund back. What can be the reason of the refund back? The reason can be, for example, on account of poor quality, on account of, for example, they mentioned that it is irrelevant for them. That between the two companies, they've decided that if they fulfill this condition, then only he will accept this specific product. For example, after receiving the product, he checks the quality, he checks everything, and he says that it is not fulfilling the purpose. Then he re-import it back into India. Then in that scenario, he has already given me funds. So in that scenario, I have to pay back that fund back to that person. So in that scenario, I have to inform the bank that according to pertaining to this invoice, pertaining to this specific receipt I have already received from that specific company, I have to refund back to the exporter. I have to refund back to the person to whom I have sold the specific product. So what the bank will do, bank will exercise due diligence. Bank will make sure that it is a bona fide transaction. I have to give whatever export incentives that I've taken, what I've received, I have to give back to the government. I have to, for example, there can be a possibility that there is not insistence on the requirement of the re-import of goods, where exported goods have been auctioned or destroyed by the port, customs, or different authorities. So there are different, like in this scenario too, I have to give some justification, and if the justification, the bank feels that the justification is right, you are genuine, then in that scenario, the bank allows you to refund back the proceeds. Because here, not only your funds are being blocked, or not only it is your funds, it is basically the government foreign exchange that is involved. So that is why FEMA Act plays a very important role when you are undertaking an international trade transaction. So I hope everything is clear to all the participants. Any questions you can ask me in the chat box. Next is set off. Set off what exactly means? When, for example, I'm dealing between India and Chennai, for example, I've made some payment, I've sold some product, I've received some specific product from that same party, and I just set off. I don't need to inform anyone. It is just for my own accounting purpose. I did the set off. But in this scenario, it will not automatically set off, because when I'm exporting, it will be mentioned in my IDPMS system. When I'm importing, it will be mentioned in my IDPMS system. So what will happen? Both my EDPMS system and my IDPMS system, both will show a pending entry, because ultimately it has been set off, but it will show in my pending EDPMS and IDPMS system because I've not informed the bank. So in this scenario, when the company is undertaking a set off of export receivable against an import payable, it is allowed, but with the permission of the bank. I have to inform the bank. Bank will say it is same with all. Bank will say that it is a bona fide transaction. The exporter is not under the ED or any investigation authority. You have fulfilled all the conditions which is there under the foreign trade policy. Set off export, and also very important case, set off of export receivable against goods shall not be allowed against import payable for services, because in the case of goods, it is routed through EDPMS system. But in the case of services, it is not. So that is why it is specifically mentioned that it is only allowed when both the cases are goods. It is, I received a goods and I've sold some goods. When there is anywhere it is involved of service and goods, then it is not allowed. That is, set off is not allowed. So I hope what we have understood till now, it all covered all the regulations which is there for the exports perspective. Now what we'll be doing is we'll be understanding from the importer perspective. So in the import perspective too, the import provisions, the general provision is the same. It is governed by the DGFT under the Ministry of Commerce and Industry. In the case of imports, it should comply and conform with the current account transaction rule 2000, which is governed by the Foreign Exchange Management Act and also the RBI. In the case of exports, what happened was, in the case of exports, the time frame which is given to me to realize an export was 9 months. But in the case of imports, the time frame is 6 months. That is, if I've imported I have to make the payment within the 6 months time frame. Now the question that arises is for example, for a layman perspective, it is saying when I'm exporting, I have to realize within 9 months. But when I'm importing, I have to make the payment within 6 months. So anyone from the audience or participants guess why the time frame given in the import is less than what is given in the exports? Because in the case of exports, the government is seeing ultimately, I'm from the layman perspective, the government will be taking the advantage when they will be receiving the foreign exchange. That is, in the case of exports, they will be receiving the foreign exchange. But in the case of exports, they've given extra time, that is 9 months. In the case of imports, they've given only 6 months. So, what according to you should be the reason of why the time frame given is less? Hello. मैं आपको ना हाफ एन आवर कॉल करता हूँ एक्चुअली ना मैं वेबिनार दे रहा हूँ मैं आपको आधे घंटे में कॉल करता हूँ ठीक है ठीक तो इसमें what we were discussing that the 9 months time frame is given in the case of exports but 6 months is given in the case of imports. So the reason why the less time is given in the case of import is the government is worried about their own reputation. That means if, for example, I have imported a specific product, I've brought some specific product, but I'm not making the payment. So it not only affects the company which is a buyer, but it also affects the India's image, because in for example, the US company will say that Indian people are the same, that Indian people doesn't even pay the whatever they are selling. So it not only impacts the company's reputation, but also the whole government or the country's image too. So that is why the government has straight away said that within 6 months time frame you have to make the payment of the import. Likewise, in the case of export, what we have studied that you can go forward with the extension of the time frame of 9 months of 6 months at a time. In the case of imports, you can take the permission from the bank of extension, or that to here also 6 months at a time, but maximum up to 3 years. In the case of imports, the maximum time frame which is given is 3 years. In the case of exports, there is no time limit. You can take extension up to any time, but 6 months at a time. Likewise, in the case of imports, you can take extension up to 6 months at a time, but maximum up to 3 years. So this is the way through which the RBI under the FEMA is functioning on the side of making the remittance and receipt of whatever the company has exported. Likewise, what you have studied in the case of export transaction of third-party payment is also allowed in the case of exports, wherein the same conditions are there. Tri-party agreement, bona fide transaction, bill of intention mention, these negotiations, everything should be same. Generally, more or less, it is same in the case of import and export activity. Advance remittance, in the case of export, what we have understood that we can receive the advance for the exports, but when, for example, I have to refund back the export advance after 1 year, then I have to take the permission from the RBI. In the case of advance remittance for imports, because here I have to make the advance remittance, it is allowed without any ceiling, but there is some conditions attached to it. Condition is if the amount of advance remittance exceeds 200,000 USD or its equivalent, an unconditional irrevocable standby letter of credit, that is LC, or a guarantee from an international bank of repute situated outside India, or a guarantee of an AD bank in India, if such guarantee is issued against the counter guarantee, is obtained. That is, it is very much important than if, for example, I'm making an advance for import. I can give it without but if it is exceeding $200,000, then I have to fulfill the condition which is there, that is unconditional irrevocable LC has to be given to the bank. Then only bank will allow me to make the advance remittance. In the case of extension, I have already mentioned that you can go forward with extension of 6 months at a time, but up to 3 years. In the case of write-off, here also, which is mentioned, they are specified that in the case of quality issues, short shipment, destruction of goods by the custom authorities, or something which is a genuine concern, you can go forward with the write-off. But here also, there is a conditions, that is up to 5% it is allowed. Above 5%, you have to go back to the AD bank and give a justification to it and satisfy the AD bank that why you're not making the remittance. Otherwise, what will happen? I'll just procure the product and will not repay. So, because it is impacting the government's image too, so that is why there are stricter norms in the case of write-off of the import payment too. Next is merchanting trade. Anyone has any brief knowledge of what exactly is merchanting trade? Anyone from the participant? What do you think is merchanting trade? What exactly is merchanting trade? So merchanting trade is basically what I'm doing is for example, I am sitting here in India, but I have imported a product from China, and without reaching it in the India's border or India's land customs, directly I send it from China to USA. That is, I as an Indian buyer or seller, I as an Indian party procure the product from China, sell directly from China to USA. The product doesn't touch the India's land border. In this scenario, it is allowed. It is allowed under the merchanting trade regulation under the FEMA Act, wherein the government, the RBI, has given the permission. If, for example, an Indian company has to take the transaction of merchanting trade, where the import and export is being undertaken without coming up in the India's land border, then in that scenario, it falls under the merchanting trade. You have to fulfill the regulations which is there under the merchanting trade. So what all are the regulations? The first and foremost thing is the whole transaction has to be completed within the 9 months time frame. That is procurement to selling. Everything, there are remittance also, the payment and the remittance. So everything has to be completed within the 9 months time frame. And also, there shall not be any outlay of foreign exchange beyond the 4 months. That means if I have made, for example, if I made the remittance for the import, that is the buy side, I've made the remittance, then I have to realize it within the 4 months. That is the maximum time frame which is given. That means there shall not be any outlay of foreign exchange beyond the 4 months time frame. So when I'm undertaking the merchanting trade transaction, the whole transaction has to be completed within the 9 months time frame. My foreign exchange outgo should not be more than 4 months. The whole transaction should be routed to the same AD bank. That means when I'm making the payment from the bank for the import, for the buy transaction, I have to use the same bank while making the remittance, while receiving the remittance in the case of exports. So only the same AD bank has to be there. I have to also take the permission, and not the permission, but I have to inform the bank, and the bank will see that the transaction is bona fide. Bank will take the KYC and different guidelines which has been prescribed to the bank. According to the guidelines, bank will ask us questions, and according to these guidelines, when the bank will feel that the transaction is bona fide, it fulfills all the purpose of the FEMA Act, then only the bank will allow and permit me to undertake the transaction of the merchanting trade. Also, a very important condition which is there is the import and export activity should be allowed under the foreign trade policy. What does this mean? This means that, for example, if I talk about sugar currently in India is prohibited. So what the merchanting trade says, it says that because in India the sugar export is prohibited, you cannot do merchanting trade transaction of sugar. Even if it is not coming up to India, even if it is not touching the Indian domestic tariff, even if it is not touching the land borders of India, even if, for example, you're selling from China to USA, that is sugar, you cannot do it because it is restricted, it is prohibited. So what they have said is only the transactions, only the goods or services which is allowed under the foreign trade policy can only be undertaken under the merchanting trade. Otherwise, it will not be undertaken. So I believe merchanting trade is clear to all, wherein the permission has to be taken. It is basically you have to inform the bank. Bank will check the bona fide of the transaction. Bank will only permit when he sees that it is a bona fide transaction. The outlay should not be more than 4 months. The whole transaction has to be completed within the 9 months time frame. So this is what we were discussing on the foreign exchange management perspective. Now what we'll be understanding will be from the understanding of the foreign trade policy. So what exactly is the foreign trade policy? Foreign trade policy is being developed by the government or the Ministry of Commerce and Industry, and it is part of the DGTRA Act, that is the development basically DGTRA Act, which governs and regulates the trade of India. So basically the FTDRA Act, the FTDRA Act specifies under the FTDRA Act there is a foreign trade policy. So what is the objective of the foreign trade policy? The objective of the foreign trade policy is simple, that it regulates the foreign trade, it develops, it makes sure that there is a development of the foreign trade. So the change that happened in the foreign trade policy was in 2023. Generally, what happened was, previous to 2023, the government came out with the foreign trade policy for 5 years. That was for 15-20, that is 2015 to 2020, there was a foreign trade policy. The government extended that foreign trade policy for 3 years, and it was extended till 31st March 2023. After 31st March 2023, the government came out with foreign trade policy 2023. Now the foreign trade policy doesn't have a end date. It is an open-ended policy where the government has come up with foreign trade policy 2023. So from the internal audit perspective, from understanding from the professionals' perspective, I'll be briefing it out. What all are the important provisions that is there under the foreign trade policy? That is, what all are the, because the foreign trade, in the case of foreign trade policy, the foreign trade policy talks about the benefits. That is, for example, I am an exporter. Generally, the government gives some kind of concessions or duty exemptions or duty remissions or basically different kind of benefits which are there for the exporter community here in India, because the government want to offset the infrastructure inefficiencies, and the government want to give, because for example, if I talk about India is currently a developing country, there are different inefficiencies that are involved. The labor cost is huge, the land is also not easy to get, the infrastructure cost of building an infrastructure, there is the different infrastructure inefficiencies in India. Transportation, that is logistic cost, is very huge in India. So government realizes that even if we are a labor intensive country, we have affordable labor, but still we are not able to produce the goods at a very affordable price. Bangladesh, Vietnam, they are able to manufacture the product at a very more reasonable price. So the government have to give some level playing field to the exporter communities. So what they're doing is, under the foreign trade policy, they are giving certain kind of export incentives. So we'll be briefing it out. I'll be just briefing it out what are the export incentives for the understanding of the professionals. So first is the pre-export, next is the post-export, and third is the procedural benefits. Pre-export is before exporting, what all are the benefits? Post-export means after I have undertaken the export, what all are the benefits? So pre-export comprises of two benefits. One is advance authorization, second is EPCG, that is export promotion of capital goods. Post-export benefit means after I have undertaken the exports, then in that scenario, what will be there are two benefits. That is DFI, that is duty-free import authorization. Second is road tax. I received one question. Is high sea sales are exempted from GST? Rajkumar ji, yes, the high sea sales are exempted from GST. So what exactly is high sea sales? High sea sales is, for example, I am an importer. I want to procure a specific product from China. So I procured the specific product from China. But before getting it cleared from the customs, I got a specific buyer. Buyer said that give that specific product to me. You don't bring, there is no need to bring that product to your factory. I'll just take it away from that custom itself. So before reaching the custom boundary or before getting it clear from the customs, I am selling that specific product to another person here in India. So in this scenario, it is called as high sea sale. That is, before reaching the custom office, before getting it clear from the customs, I'm selling it to the selling it to a buyer which is there in India. So the government, the GST department, GST Act has come up with a specific notification in this scenario of high sea sale, which specifies that in the case of high sea sales, that what transaction has been undertaken between me and the specific buyer, I don't have to pay the GST. Also, for example, I imported at, for example, $100,000. I sold it to him at $125,000. Now, I didn't pay the custom duty. The custom duty will be paid by the person who will be actually getting it cleared at the customs. So he will be the person who will be getting it cleared at the customs. So what the GST Act and the Custom Act mentions, that the assessable value in this scenario will be the value at which I and that person has dealt with. That is at the price of $125,000. At that price, the custom duty will be BCD will be levied, and on that price itself, the IGST will be levied. So GST will not be levied in the transaction between I and that specific buyer. It will be levied at the time at which that specific buyer will clear the specific product from the customs. At that time, the BCD, the custom duty will be levied, and at that time, the GST will be levied. So Rajkumarji, I hope I have cleared the high sea sale as well as the implication of it under the GST Act. So next, what we were discussing was the foreign trade policy. The foreign trade policy we were discussing was, there are two parts to it. One is a pre-export benefit. The second is a post-export benefit. Pre-export benefit is the advance authorization and the EPCG scheme. Post-export benefit is the RoadTap scheme and the DFI scheme. Because of the paucity of time, I'll just brief out all these schemes for the general understanding of all the people. So first, we'll be understanding the RoadTap scheme. RoadTap scheme is basically the post-export benefit. What exactly is the RoadTap scheme? RoadTap is remission of duties or taxes on exported product, because I've already mentioned that the Indian companies faces some certain kind of inefficiencies, or there are certain duties which is not being reimbursed by the government. For example, GST, when I'm exporting from India, GST is being refunded by the government. But there are certain duties like, for example, road tax, for example, electricity duty, stamp duties. These are duties which are not being refunded or reimbursed by the government when I'm exporting. So what the government has come up, government has come up with the RoadTap scheme. The RoadTap scheme mentions that on the percentage, on the FOB value of the export, you will be getting a percentage of the incentive. For example, my FOB value is $1 million. And on the specific product, the government says that 1% will be given to you as an incentive. So 1% of 1 million, that is 0.1 million, 0.01 million, I'll be given as an incentive by the government under the RoadTap scheme. So this incentive is being given to me not in the form of cash, that is, it is not a bank transfer, it is being given to me as a duty credit script. So what exactly is duty credit script? It is basically a script, basically a certificate by the government, which says that you are entitled to this much of incentive. So what is the purpose of the script? How can I use the script? Can I just go to the bank? Can I just go to the RBI? Can I just go to the customs and say that this is a script that I've been received and just give back the money? It is not the case. I can use the script only for the purpose of making the payment for BCD. For example, I'm an importer too. I have to make the payment for BCD, that is basic custom duty. I have to pay at the time of import. Then, like rather than paying it through cash, I can pay through the script. So in the case where, for example, I only export, I don't import. So in that scenario, that script is not much of use to me, because I have received the script by the government, but I'm not importing anything. So in that scenario, the government has said, if you are only exporting, you can transfer the script to a person who is an importer. So it is a very liberalized scheme, where the government has said, on the percentage of the FOB value of export, you will be getting certain kind of benefit as a RoadTap scheme, as a RoadTap benefit, of which you will be given a duty credit script. That duty credit script will be used to make the payment of only basic custom duty. If you are not eligible, if you are not an importer, you don't need to pay the basic custom duty. You can transfer the script to a person who is a willing buyer who needs to pay the custom duty, and he will be using the script to make the payment of the BCD. So these are the ways through which the RoadTap benefit is taken. These are the ineligible categories under which you cannot take the benefit of RoadTap. That is I'll just brief it out. The categories are basically goods which are restricted or prohibited for exports, transshipment, deemed export, that is export to UU, exports like sold, like selling a product to a person who is advanced authorization holder, to a person who is EPCG holder, goods manufactured and supplied by units in DTA to a unit in SCZ, goods which have been taken into use after manufacturing, goods manufactured partially or wholly in a warehouse under Section 65, that is mover regulations. So these are the ineligible categories which are not allowed to take the benefit under the road tax scheme. So this was, I'll not cover much more. I'll cover the next topic, which is the advance authorization. Advance authorization is basically a very important scheme, and it leads to a very different procedural issues in case where, like what we have practically seen, the different issues which is there in the compliances of different companies. So as an internal audit perspective, you have to make sure that these regulations or the compliances have to be fulfilled. Because when I'll just brief about the advance authorization scheme and also the obligation, then you will be understanding of why there are different issues. Advance authorization scheme is basically a scheme where I can import raw material duty free, that is without payment of custom duty, any custom duty, that is BCD, cess or GST. I don't have to pay any duty. I can import the raw material duty free, but subject to I have to make a 15% value addition of it and export the finished goods. That is, for example, I have imported the raw material. Through that raw material, I have manufactured a finished product. That finished product has to be exported outside India with a value addition of minimum 15%. Then only I can take the benefit of this specific advance authorization scheme. So now what all question arises? First question that arises is, in the case of export, that is the finished product, what all, for example, I want to export laptop. Now I want to export laptop. What all are the inputs that is required? I'll just mention to the government that I'll be requiring chargers, I'll be requiring this, I'll be requiring semiconductor, I'll be requiring PCB, something and something. But what the government has said that you can import according to your finished product. If, for example, there are four parts to it. One is SION, that is standard input output norms. Government has defined some standard input output norms wherein the government has said, for example, to manufacture a laptop, these all are only inputs that you can import. There is also a case of self-declaration, that is, I myself can self-declare that, for example, to manufacture laptop, I will be requiring this specific product as a raw material, but I have to get it certified by a chartered engineer. Then the DGFT will say, then the DGFT will like review my application and think and say and feel when they think that it fulfills the conditions that the input and output is actually synced, then only it will give the advance authorization scheme benefit. So in this scenario, I have to justify why the input is required to manufacture the finished product. Next question that arises is the time period. That is, I have to import within the 12 months and I have to export within the 18 months time period. For example, I have received the advance authorization as on today. So as on today, after today, within 12 months I can import, and from today 18 months I can export. Now the question that arises, the practical issues that arises is, the company is not able to fulfill the export obligation within the 18 months time frame. Also, the company is not able to have a value addition of more than 15%. So in this scenario, also the advance authorization is issued on the actual user condition. That means if I have been given the advance authorization, I only have to manufacture the finished product, I only have to export the product, then only I'll be able to get the benefit under the advance authorization scheme. So there are many instances where, for example, I imported the raw material. Then what happened? There is, for example, my whole sector faced different issues. For example, COVID came. So in the case of when the COVID came, I'm not able to export. If I'm not able to export, so how will I be able to fulfill the export obligation? So these are very much practical difficulties which is faced by the exporter, that they are able to take the benefit under this advance authorization, but they're not able to fulfill the obligation which is there. So as an internal auditor, we have to see whether they are fulfilling the conditions which is there under this advance authorization scheme or not. So we have to see whether the input output norms are met, validation criteria is met, time period which is there is also met, actually the condition is met. So these are all the ways through which we have to see whether the company is fulfilling all the conditions which is there when they are taking the benefit of the advance authorization. So as I mentioned, advance authorization, I can import the raw material duty free. Duty free means no duty. BCD says IGST, anti-dumping safeguard, nothing I have to pay. Everything will be imported duty free, but subject to there is the export obligation which is there, that is I have to make a minimum valuation of 15% with making the export within the 18 months time frame. Next scheme is DFIA, that is duty-free import authorization. What exactly is duty-free import authorization? Advance authorization was a scheme in which it is a pre-export. That is, before exporting, I have to import the raw material. I have to manufacture the finished product, and the finished product is being ultimately exported outside India. So before importing, I have to take the permission. I have to get the advance authorization from the DGFT. But in the case of post-export, when I am exporting first but importing later, that comes the DFIA scheme. DFIA scheme objective is the same. You can import the raw materials duty-free. But in this scenario, what you have to do is you have to apply to the DGFT that you want to take the benefit of DFIA. They will be issuing you a file number. First, what you have to do is you have to export. When you are exporting, you have to mention the DFIA license in all your shipping bill. According to your exports, the government will give you a license that according to this export, this raw material you can import duty free. In the case of DFIA, it can only be on the SION basis, that is standard input output norms basis only, which is prescribed by the government. Only in this scenario you can take the DFIA benefit. In the case of advance authorization, you have other options too, like SION is also available. The other is self-declaration basis is also available. So in the case of DFIA, only in the case of SION, you can take the benefit. So this is a post-export benefit. That is, after exporting, I can take the benefit of duty-free import of raw material. So another condition is 20% value addition. That means a person has to, in the case of advance authorization, it was 15% value addition. DFI, in the case of DFI, it is 20% value addition. In the case of advance authorization, the benefit was of the duty-free import was for all the duties, that is BCD, cess, IGST, anti-dumping, safeguard, countervailing. In the case of DFIA, only BCD is exempted. All the other duties has to be paid. Export shall be completed within the 12 months from the date of the online filing of the application. So this is the basic feature of the DFIA scheme. Any questions regarding the advance authorization or DFIA, you can ask me in the chat box. Next is the duty drawback. Duty drawback is basically also the post-export. That means after the export that I have undertaken, government will give me a duty drawback. What exactly is duty drawback? Duty drawback is basically when you are exporting, likewise, like we have understood on the road tab scheme, because of different inefficiencies or infrastructure disabilities which India has, the government is giving basically a road tab incentive on the basis of the FOB value. Likewise, duty drawback is also received on the basis of the FOB value. The percentage is defined by the central government. That, for example, if I'm exporting laptops, for example, laptop has 2%. So 2% of the FOB value of my export, the government will give me an incentive as a duty drawback. In the case of duty drawback, it is automatically being given to me as a bank transfer in my bank account. My application, filing of the shipping bill is my application for the duty drawback. I don't have to apply it to the government again for getting the duty drawback benefit. But in the case of road tab, I had to apply it. I had in the case of road tab, I did not receive a bank transfer. I received a duty credit skip. In the case of road tab, in the case of duty drawback, you will be receiving a direct bank transfer to your bank account, when automatically, as I mentioned, the shipping bill is basically an application to avail the benefit under the duty drawback. Next is the last point that we'll be discussing because of the time limit, is the EPCG scheme. EPCG scheme talks about that I can, like in the case of advance authorization, I can import raw materials duty free. In the case of EPCG, I can import capital goods duty free. That means capital goods, for example, to manufacture laptops, I need advanced capital goods. So to manufacture that advanced capital goods, I can import the capital goods duty-free into India. Duty-free means no duty. That is IGST, cess, BCD, nothing will be levied. So I can import the capital goods duty-free. In the case of advance authorization, what we understood was there was an export obligation of, that means 15% value addition, and you have to export the finished product within the 18 months time frame. In the case of EPCG, there is an export obligation. The export obligation is 6 times the duty saved. For example, I imported a capital goods of 1 crore rupees. 1 crore rupees, 20%, for example, was the import duty. So what the government is saying, 20%, that is 20 lakhs that you have foregone, that we have given you as a foregone of duty-free import of capital goods, you have to have a export obligation of 6 times the duty saved. That is 6 times the 20 lakhs. That is 1.2 crores of export has to be undertaken in the next 6 years. Then only the EPCG scheme benefit you can avail. So what happens? The company takes the benefit of EPCG. They import the duty-free raw material. They import the capital goods duty-free, but they're not able to fulfill the obligation which is there under the EPCG scheme. So this leads to very much difficulties, for example, for the company's perspective, because ultimately after 6 years, they have to pay back to the government not only the BCD, not only the custom duty, but also with interest of 15% per annum. So after 6 years, that comes to 90%. That means duty, interest also equivalent to duty. So this is a huge liability for the company. So that is why under the EPC scheme, as an internal auditor or as a professional, we have to see whether the company is able to fulfill the obligation or not. So what the obligation is, you have to fulfill the obligation of 6 times the duty saved amount within the next 6 years. Also, this is a specific obligation. Apart from the specific obligation, there is an average obligation also have to fulfill. Average means whatever exports that you were already undertaking in the preceding 3 years as an average, that you have to continue. Above that, specific 6 times the duty saved amount you have to also fulfill. So there are 2 parts to it. One is average, second is specific. Average means the average what you are already doing in the last 3 financial year, what you are already exporting, you have to do it as it is because you are already exporting that. What is the purpose? The purpose of importing the capital goods is that it is improving your efficiency. It is improving and it leads to increase in your exports. So in this scenario, you have to fulfill the specific export obligation of 6 times the duty saved amount in the 6 years time frame. And also there is a condition that second-hand capital goods cannot be imported under the EPCG scheme. Authorization shall be valid for 18 months. That means within the 18 months, I can import the capital goods. Capital goods comprises of all capital goods, computer software systems, spare parts, molds, dies, jigs, tools, fixtures, everything is involved in the capital goods. These are the negative list in which the capital goods you cannot take the benefit of the EPCG scheme. That is, for example, cables, construction equipments, computers and printers, all second-hand goods, airport ground handling equipments. These are the schemes. These are basically the products for which you cannot import under the EPCG scheme. As I've already explained, specific export obligation and average export obligation. There is also an incentive when you are incentive for early export obligation. That means if within the specific time frame of less than half of the time frame of 6 years, you are able to fulfill it, then the export obligation reduce to 75% rather than 100%. In case of green technologies and products, you are already eligible for reduced export obligation of 75% because government wants to encouraging these specific green technologies. In case of Northeastern region and Union Territory of Jammu and Kashmir, there is a condition of specific reduction in the export obligation. Third-party exports is also allowed under the EPCG scheme. And there is also a scheme called status holder scheme, which because of the paucity of time, we are not able to complete. And for my discussion, I wanted to cover the free trade agreements. I'll just brief about FTA in just a minute. FTA is basically free trade agreements. Just like DTAA in income tax, FTA is basically for the duty-free or duty concession or exemption in the case of import and export. Recently, the government signed it with Australia. Now they're planning to sign it with the UK. So in the case of Australia, what they have is they signed it in it was last year. 31st December 2022, on which the trade agreement was signed between the two countries. For example, I want to export or I want to import from Australia, it will be imported at a reduced or a concession way into India. That means the custom duty will be reduced, or there will be reduction or exemption in my custom duty, but there is a specific conditions attached to it. That means a certificate of origin has to be taken from the exporting country, that is from Australia, that specific product was being manufactured in that country. Then only you are eligible to take the free trade agreement. Otherwise, what will happen? The product will be routed from Australia, like it goes from China to Australia and then to India to take the benefit of FTA. So FTA is a very important thing from an international trade perspective, when we are understanding that the compliances which is there under the FTA, because each FTA has a different compliance. And also a auditor rules has been introduced under the Customs Act, which specifies that it is the obligation of the importer to see that it is fulfilling, the specific product is fulfilling and the specific buyer is fulfilling the criteria which is there under the agreement. So it is a very important thing from the internal audit perspective. When you are undertaking internal audit, or when you are as a professional, you are undertaking an audit of any company, you have to see whether their company is fulfilling the criteria and the obligation which is there under the FTA. So this was all from the perspective of the coverage of the international trade. Because of the paucity, I tried to cover all the important provisions which is there. I hope I was able to clarify all the questions which were there in the chat box. Currently, there is no pending questions in the chat box. So anyone has any questions of what we have understood, or what we have covered in today's session, you can ask me in the chat box, or you can just note down my mobile number or my email ID, that is 9811226085, or my email ID is camanashuk@gmail.com. You can shoot an email, or you can just message me any queries related to international trade, or any questions related to import export, foreign trade policy, customs, FEMA, GST, trade remedies, trade agreements. I will be happy to help each and every professional. Thank you everyone for joining in today's session.